Okay, but I'm not going with the time now, right? I'm gonna go through to the very end of the lecture, okay? Okay, so we are here. Okay, so, oops. Okay, accounting for inventory errors, okay? So account has two balances, right? The beginning balance and the ending balance, right? Because the first year's ending balance, right? That ending balance is used for the calculations of the first year's cost of goods sold. And then this ending balance becomes the opening balance of the subsequent year, right? So it was the beginning balance in the first year, and then it's the ending balance in the first year, and then it's the beginning balance of the second year, right? So you can see that the one inventory balance is used twice, right, for the calculations of cost goods sold in 2 years. Okay, so if you screwed up with that number, the ending inventory of the first year, you potentially introduced errors in 2 reporting periods, right, affecting 2 periods. So there are different ways the inventory errors can happen. Okay, maybe for example, the purchases, right? Purchases, accounts payables, right? So maybe when you made a purchase, but you forgot to record it, right? So maybe the items, the inventory has been shipped to your warehouse, but for some reason, this inventory was not picked up in the accounting record. Okay. The key here, if you want to know the effect, the key is to see how we use this calculation, inventory flow equation. Cost of goods sold equals beginning inventory plus purchase minus ending inventory. So that's the purchase here. Okay. So let's take some examples, right? So first thing is inventory included, purchase omitted. Okay. So in this picture, so inventory included. So then you remember you do physical inventory count, right? So your inventory is included. So you pick that up in the ending inventory, right? But the purchase is omitted. So that means your purchase is understated, right? Your purchase is understated. And your inventory level is okay, right? You didn't do anything wrong with the inventory that has been included in the inventory. So what happened to the cost of goods sold? Anyone? So your purchase is omitted, so it's understated, right? And your inventory included, so these numbers are correct. So what happened to the cost of goods sold?
Will be underestimated.
Yeah, so your cost of goods sold is underestimated, right? Yeah, very good. So then for the following period, there's no effect, right? Because your ending inventory number is correct, right? So it's become the beginning inventory for the next period. So if nothing else is wrong in the next period, there's no errors in the next period. Example 2, inventory omitted, purchase included. So this beginning is okay, purchase is okay, but the inventory is omitted. Okay, the inventory is omitted. So what is going to happen? So maybe what happened is, you didn't. The inventory came, but you set it up in a different location. You forgot to include it into the warehouse. When you are doing the inventory count, you forgot that, in that small room, actually there are some other inventories, right? But all the other items is in the main warehouse, right? But you forgot that there's a small room where you put some inventories. So those inventories are omitted, but in your accounting record, you know that you have purchased it, right? So your ending inventory will be what?
It'll be smaller, which will cause your cost of goods sold to seem like it's bigger.
Yeah, very good, right? Because you forgot to count those inventories, so your physical count of inventory will be lower, right? So your ending inventory will be lower, and then according to this equation, your cost of goods sold will be higher, right? Does that make sense?
Yeah.
Yeah, good. Okay, and 3, inventory omitted, purchase omitted. Okay, so maybe somebody, this is error, right? Maybe the suppliers, shipped these items and you put it into this small room, right? And then the accountants only record items goes into the warehouse. So this item was not picked up by the accountant. So the purchase was not recorded. Okay. Maybe the invoice has not come yet, right? The suppliers, they will bill you for the items shipped to your warehouse. Maybe the invoice hasn't come yet, so the accountant did not pick up this purchase, right? For whatever reason, purchase omitted, inventory omitted. What's the effect to the cost of goods sold?
It reduces it.
Okay, suppose the purchase is omitted by 200, right? And the ending inventory is omitted by 200. What's the net effect to the cost of goods sold?
Nothing, because it balances out, right? Or
Yeah.
it appears as nothing.
Yeah, because it's purchase minus ending inventory. If this number is lower, the difference has no change, right? There's no change on the difference. Is that right? This is just math, right? Just math.
Yeah, it makes sense.
Yeah, okay. Incorrect costing, right? Incorrect costing, that means you are using, maybe you're supposed to use FIFO, but you use the weighted average, right? Or maybe some other errors could be the price is $7.8, that's the cost, but the accountant think it's 8.7, right? Those errors. So how those will affect, the cost of goods sold, right? So the point here is the first 3 examples, they have a physical element, right? Talking about purchase and inventory. And the example 4 is really purely about calculations, right? This has nothing to do with the physical perspective. Presentation and disclosure, okay? So balance sheet present inventory separately, right? So basically you do not, this is a current asset, but you have account receivable, you have inventory, you have prepaid, right? So inventory account is presented separately. Cost of sales does not need a separate presentation. Included in operating expenses, disclosure required versus a separate presentation. Okay. This is a little bit confusing. Cost of sales does not need separate presentation. For the income statement, okay, for the income statement, oh, I see. It's cost of sales, not the cost of goods sold, right? For the manufacturing companies, merchandise companies, in 2100, remember we talked about the 2 different formats, right? You have a single step for service companies, which only report revenues and expenses, right, and income. But for merchandise companies, industries, you go with 2 steps, right? The first step is revenue, cost of goods sold, right? and you get a gross profit. And then you have operating expenses, and then the difference is your net profit. Do you remember that? Here, they are talking about the cost of sales. Maybe it's a selling cost, okay? So that's part of the operating expenses. Disclosures required for amount of written down in a period. You have to be clear what is the dollar amount of write down in a period, right? The $300 in our scenario. Any write downs reversal in the period, right? Maybe you reversed a previous inventory write down, right? So you have to disclose this information. Pledged inventories as collaterals for loans, right? So so there is these inventories are restricted, right? In the sense that they work as collaterals for loans. So remember accounts receivable? Do you remember that? We can sell account receivable for factorings, right? If you were reviewing the chapter 5, remember in one case, if it's the accounts receivable sale with no recourse, with recourse, okay, with recourse. There are two scenarios: the AR to the factor. The two conditions. One is with no recourse. Okay, in that case, you treat it as a sales of account receivable. And then in the second case is with recourse. You treat it as a short-term obligation, short-term secured obligation, right? And you secure it against the AR, right? So you could also have loans secured against the inventory, right? Secured against the inventory. So, so that's the case. You have to be kind of clear in terms of the pledged inventories. And then what's the accounting policies for inventories? So for example, here, this is the note disclosure for the this company's financial statement. So here is the policy disclosure. Inventories comprise raw materials, work in progress, and the finished goods, right? So now they tell us there are 3 different types of inventories, which are valued at the lower of cost or market, right? Here, you see, this is the policy, right? They are valued at the lower of the cost or market on the first in and first out basis. So the cost of flow assumption is FIFO, right? It's FIFO. Cost for work in progress and the finished goods inventory include the materials, direct labors, and the allocation of overhead. So nothing surprising. This is 2,400. Market for raw materials is replacement cost, right? So the market price for the raw materials is replacement cost. And for work in progress and finished good is net realizable value, right? Remember just before they left, Tim asked me a question about what if they have both, right? Replacement cost and net realizable values. So from this company, it's pretty clear for raw materials, they are using replacement cost. But for finished goods, they are using net realizable value, right? So see, all this information disclosed will be useful to the users to make a judgment on the inventory balance. Okay, so I'm at 67. So this is the practice illustration on the Canadian Tire, okay? So I don't have a picture of this, but it's in the textbook. Okay. So I'm going to just skip these 2 slides for now, okay? I will bring some pictures from the textbook in another video on this. Potential earnings management using inventories, okay? So what time is it? Okay, 2 minutes over. So put up with me for a few more minutes, okay? I'm almost done. Potential earnings management using inventories. In the previous slide, we are talking about because they're using absorption costing, you could overproduce units. When you overproduce the units, there's going to be a large amount of balance sitting on the ending inventory. And that large balance of ending inventory is going to absorb a lot of the cost. So there will be less cost flow through the income statement. So therefore, you are inflating the earnings, okay? Here, for example, if you need to write down an inventory, okay? But you are not doing this, right? In that example, your cost is 200, but the NRV is really 180, right? You don't want to do it because in that entry, you have to debit the cost of goods sold, credit inventory. So when you debit the cost of goods sold, you are increasing the cost, right? So your earnings will be lower. So if you do not do the impairment write down, you could increase the income, okay? What else here? Including non-production cost in inventory, okay? Remember, there are two types of cost, product cost and period cost, right? So product cost will be included in the inventory. Period cost will be going to the income statement. So now if you include this non-production cost in the inventory, so those costs will sit in the balance sheet. It's not gonna flow through the income statement. Therefore, you are manipulate the earnings upward, right? LIFO is used in US. It's actually 50% of the large US companies are using this method. Okay, that's quite surprising. But for the benefit of this course, we are not using LIFO. Okay, we use FIFO. In your CPA exam, you are not gonna use LIFO. Okay, because LIFO is not accepted in Canada. Okay, that's everything. So yeah, so I think that's everything. Do you have? Just give me 1 second. Did somebody ask a question?